on this edition of Money Life.
We have a lot of risk. Almost none of that is priced in, not just in U.S. equities, but in U.S. corporate credit spreads, in European equities, in Japanese equities. The list goes on and on and on. So I am certainly concerned about volatility between now and the end of the year. Volatility does work in both directions, but I wouldn't be surprised if, as we start to see tariffs really begin to work their way into the economy and that impact is more felt, for asset valuations to reflect those risks accordingly.
That's Julia Hermann, global market strategist at New York Life Investments, who will be talking about their Megatrends report, which looks into what's happening on the global debt picture, but will also give her take on the market and the economy. And she will explain why, despite all of those risks, she thinks the risk of recession is down. It's a wide-ranging big interview, but before we get to that, Todd Rosenbluth is here with his ETF of the week. And last week, he was super conservative. This week, he's leaning into what the market's been doing. Plus, Greg McBride, chief financial analyst at Bankrate.com, goes off the news as we look at what the Fed might be considering and what it all means when they make their announcement later this afternoon.
It all starts here.
It sure does start here. This is Money Life for June the 18th. I'm your host, Chuck Jaffe. Thank you so much for joining us. We have a great show planned and executed. And it's a little different on our timing elements because normally Todd Rosenbluth from Vetify gives us the ETF for the week on Thursdays. But we're not going to be here tomorrow because the market is closed. It's the Juneteenth holiday. And when the market is closed, so are we. So we'll bring you the ETF of the week a day early. And then, we might have done an interview with Greg McBride earlier to set you up. It's not just that he's talking about what the Fed's going to do today because he's looking bigger picture. And I think we know what the Fed's going to do today, which is nothing. But you will hear some disagreement in terms of what Greg thinks the Fed is going to do for the rest of this year and what Julia Hermann thinks the Fed is going to do in the rest of the year. Maybe even with what I think the Fed is going to do for the rest of this year. Although I think we all agree at what is possible, and what you have really is the full spectrum. You have the full spectrum. Though Julia and I are pretty close to being on the same page, I think she is a little more likely on the Fed will make at least one cut, and I am of the camp that the Fed's only going to cut if they absolutely have to. It'll take news, significant news that we don't necessarily see happening on numbers or what have you, for the Fed to make a move, in my opinion. Now, all that said, my opinion is the least important one on this show. Your opinion is particularly important, at least in terms of how you process the show, but it's also important to me. And I would love to hear from you, chuck@moneylifeshow.com. But my opinion, well, I'm not suggesting that I don't know anything or anything along those lines, and I'm not being self-deprecating. I'm just saying this is not a show where you come here necessarily to hear the host wax poetic about the market or whatever. That's not really what I do. I talk to others. We are an interview-driven show, and my guests are the stars of the show. And Julia Hermann is a rock star. She is super smart and one of those folks that, it's funny, there are a number of people who are on the show who also at times listen to the show, and they will periodically send me notes. Julia was on for the first time in February. I got notes from two guys who are on this show a couple times a year who are very big names that you would know, who are like, I don't say this to you often, but who was she? Super smart. So, you'd like to think the investment world is super small. Everybody knows each other. They bump into each other in the green room at CNBC or something, but that's not really what happens. Yes, they do at times get together and meet in industry conferences and things along those lines, but I can't tell you the number of times I go to one of those events. Heck, I was at an industry event last week, and you're meeting people for the first time, or they're putting it face to face for the first time, even though they've known each other, right? Like I sat in, we had Bob Marcotte from Gladstone and Mitchell Penn from Oppenheimer. I don't know if they had ever met because I didn't see that, but I joined them briefly for a conversation because I was arranging interviews with both of them. They were talking about how much they kind of enjoyed the face-to-face. Oh, we get a chance to actually see some of the people that we talk about and too. So it happens, but I think you will enjoy that interview. I hope you do. And let me know what you think. chuck@moneylifeshow.com. It should be an interesting day on the market. I don't want to get too focused on the day-to-day, but with tomorrow being an off day and you've got all of the things happening in Israel and Iran, and that has a direct impact on the market because it impacts oil, but you also have the Fed. No, I don't think anybody's going to be surprised, assuming that the Fed decides not to cut rates. It's the guidance that they give and how much the market thinks any of that has been priced in. I believe most of it has been priced in, so I don't think the Fed's going to do much today. But you'll get an interesting take on what it means and what folks are looking for and whether rate cuts mean what they always mean, because we're going to discuss that with both Greg McBride and Julia Hermann. So we've got these great interviews that I'm telling you about. Let's jump into it. Again, the unusual ETF of the week on a Wednesday. Then Greg McBride and Julia Hermann. It's a great day to live the money life. I promise you'll be happy you're here, and I'll start proving that to you when the talk starts after this message.
To navigate today's complex market, investors need accessible, quality research. VettaFi offers free webcasts from portfolio experts and industry leaders. Earn CE credits and take your portfolio to the next level. Go to etftrends.com/webcasts and learn more.
One fund on point for today, the expert to talk about it. This is the ETF of the week. Welcome to the ETF of the week, where we get the latest take from Todd Rosenbluth, the head of research at VettaFi. And at VettaFi.com, you'll find all the tools you need to be a savvier, smarter ETF investor and to get more details on the new, newsworthy, trending, and timely ETFs that we discuss here. Todd Rosenbluth, it's great to chat with you again.
It's great to be back, Chuck.
Your ETF of the week is
the Invesco S&P 500 Momentum ETF, SPMO.
SPMO, the Invesco S&P 500 Momentum ETF. Well, the market has had momentum. It's trying to break through to new record highs. Is this basically ride the wave and that's it? Or is there more to it right now?
So this is less of a projection that people should ride the wave and more that they have been. SPMO has been very popular this year. It's seen $4 billion of net inflows. That's accelerating in most recent 4 weeks. It's really exciting to us when we see an ETF that's been around for a while, but now is starting to get the momentum, pun unintended. And so this is using the S&P 500 stocks. It's the 100 stocks with the best relative strength. And I know we can talk about the relative strength with the audience quite often. But what's inside this surprised me. We can maybe talk about that. It's performing quite well. The trend has been the friend with this ETF. I wanted to take a closer look.
Let's take that closer look. Let's dig in on the portfolio, because anytime you're dealing with S&P and then put a word, an adjective, momentum, quality, whatever it might be, you are looking at how somebody is straining and sifting through the index. So how are they doing this? Is this done with an overlay strategy of some sort? Is this done by getting rid of the slow pokes? What's going on?
So this is the 100 stocks every 6 months that have the best momentum characteristics, relative strength, and I can't get into the weeds on specifically how they're doing it from memory. But every 6 months, the portfolio rebalances with 100 companies. It's sometimes just more than 100 stocks if they pick a company that has more than one share class behind it. I had expected this to be mostly technology stocks, and I'm pleasantly surprised to see financial stocks. JP Morgan is one of the top 10 holdings, to see consumer staple stocks. Walmart and Costco are among the larger holdings, the top 10 holdings as well. So you do get exposure to technology stocks, NVIDIA and Broadcom, but this is not just a growth strategy. And people tend to think of momentum investing as growth investing, and that isn't necessarily the same. What you're going to find inside this portfolio is going to be different, and it's not a static portfolio.
But it is S&P 500 stocks, and people will have plenty of S&P 500 in their portfolio, even if they don't have an index fund, if they just have a plain vanilla growth fund. So how are we doing this? Like, if you have never been a factor investor, and momentum is a factor, the same way quality could be, low volatility could be, et cetera. If you've never been a factor investor, or if your factors have only been really growth and value, does this play well and mix well, or is this just a lot of overlap?
So I think this is a way to overweight exposure to a factor. So many people own S&P 500 based ETFs and mutual funds from iShares, Vanguard, State Street, what have you. This you can complement onto that. So this is a risk on strategy. Surprised you didn't bring it up. We talked last week on perhaps the lowest risk strategy that I could possibly have come up with tied to treasury bills. So that was a risk off strategy. This is a risk on strategy. You can add this. This is probably not a good core position. This is a complement to your S&P 500 exposure to overweight those stocks that are more risk on in nature. And they aren't necessarily the largest stocks. So yes, it's the S&P 500. And yes, I cherry picked a couple of examples off the top of my head that are large cap stocks. But Apple and Microsoft, I believe, are not inside this portfolio. So you're not necessarily double dipping on all of those mega cap stocks, just some of them, as well as some other more moderately sized S&P 500 companies.
Because this is kind of an add-on, a way to lean in. Is this, in your mind, less of a core position, add this and hold it forever? Because I want to point something out. Now, you are not a trend follower. You are not the guy who we say, hey, what about the 200-day moving average? The last time SPMO was below its 200-day moving average, it went below its 200-day moving average on April 2nd, on Liberation Day, as the tariffs came out. And it came above its 200-day moving average about 3 weeks later, basically as the market had done it. So it missed, if you did the 200-day moving average, virtually the entire V-shaped downturn that we had. And now it's again above its 200-day moving average. So is this maybe, because it's momentum oriented, the quintessential, you don't want to necessarily lay this down forever?
So I'm going to trust you on those facts that I didn't know coming into this conversation. But yes, I think this is a more tactical move. If you believe that we are going to continue to see new highs and we're going to see the stocks that have led the market continue to lead the market, then a momentum strategy works out very well. This rebalances every 6 months. So if the trend shifts and all of a sudden a different group of stocks leads the market higher or bounces back and leads the market higher, you will not necessarily capture that with this ETF. That's why I think it's good that this is added on to a broadly diversified portfolio. So you're still getting that exposure to all of those large cap stocks, but that you're overweighting those if you believe the trend is your friend.
So like you said, this is a risk on choice, something you want to consider when you're going, yeah, like the looks of it, risk on, as opposed to last week where it's don't like the looks of it, go risk off.
Exactly. This fits in very well for somebody who's willing to take on additional risk. And we're going to offer up a number of different ideas in this ETF of the week based on the market environment and based on what is catching our attention, based on the flows and what's going on in the marketplace. I think SPMO is a great ETF to get exposure to momentum investing in a broadly diversified manner.
It's SPMO, the Invesco S&P 500 Momentum ETF, the ETF of the week from Todd Rosenbluth at Vetify. Todd, interesting choice. See you again next week.
I'll see you next week.
That's Todd Rosenbluth. He's head of research at Vetify. Go to vetify.com for more information. Dig into their research. Use it for your funds or the things you're considering and more. And of course, Todd normally starts us off every Thursday on Money Life, but this Thursday we're taking the day off because of Juneteenth. So he's here to start us today. But the rest of the show, well, it'll look like what a Wednesday show might do. Like we've got a big interview with Julia Hermann from New York Life Investments. But up next, we're going off the news. Greg McBride will be here to talk about what he's expecting from the Fed today. That's coming up when Money Life returns in a moment.
Everything an advisor needs can be found in one award-winning newsletter. Advisor Perspectives takes the most important financial perspectives and delivers it right to your inbox. Go to advisorperspectives.com and stay informed.
Welcome back to Money Life, where we are going off the news. And of course, the news this week around the markets is that the Federal Reserve is meeting, and it's going to make an announcement on Wednesday afternoon. We're going to discuss what the Fed is likely to do, what we expect, and more with Greg McBride. He's Chief Financial Analyst at Bankrate.com. That's where you go if you want to find more information. And of course, they not only have things like coverage of what's going on with the Fed and the rest, but if you're looking for better bank rates on any of your financial products, they can do that for you as well. Greg McBride, welcome back to Money Life.
Always great to be with you, Chuck. Thanks for having me.
I don't want to immediately put the kibosh on our discussion, but my expectation is that this is going to be kind of a nothing burger because I'm not really expecting the Fed to do much. So if the Fed's not going to really do much, what specifically are you hoping to hear or not hear in whatever they do say?
They do release their updated quarterly projections for the economy, interest rates, inflation. And so that's where the focus is going to be. Specifically, how have those forecasts changed since the last time in March? What is the sort of middle of the road consensus among the members of the Fed with regard to interest rates? Back in March, the middle of the road expectation was that they felt they were going to cut interest. They were projecting they would cut interest rates twice by the end of the year. We're halfway through the year now. Do they still feel that way? Or has that needle moved? That's really where the focus is going to be. There's nothing compelling the Fed to cut rates at this point. The economy's still in solid shape. We've seen some softening in the labor market, but that was expected. Unemployment's still really low. And we've seen a better trend on the inflation numbers in recent months. It's just that the uncertainty about tariffs and what impact that might have in the coming months, it's kind of created this sort of waiting for the other shoe to drop feeling. And that's what's keeping the Fed on the sidelines for the time being.
I have said I don't actually expect a rate cut this year, which I know still kind of puts me in the minority. We've seen the market, as you said, the Fed was looking at potentially 2 rate cuts. The market entered this year expecting more, hasn't had them. That, of course, happened last year as well. Where are you on what you expect the Fed to do? I mean, rate cuts coming and when, if they're coming?
I do think that we will see the Fed reducing rates in the second half of the year, once, maybe twice. And I think the catalyst for that is going to be just continued weakening in the job market, that'll be the catalyst for the Fed reducing rates. The economy has continued to surprise to the upside time and time again. So your no rate cut forecast, I can easily envision a scenario where that occurs. The economy continues to stay resilient, but we see inflation pressures start to tick up a bit. Well, there you go, right? And that keeps the Fed on the sidelines to the end of the year. So, not difficult to craft that scenario. The flip side of that is if we do see deterioration in the job market, and especially if it comes quickly, that's the catalyst for the Fed cutting rates and potentially cutting rates in a bigger hurry than would otherwise meet the eye.
As for what you were expecting from the Fed, everyone hears rate cuts and they think in rate cuts, this is what I get, rates come down, etc. But the rate cuts we saw last year didn't have that broad effect. Is the market that the Fed will be cutting to, if they make cuts later this year, the same as what we saw last year in terms of we're still not going to expect rate cuts to have a big impact on mortgages and the rest? Or is this going to be the rate cut, of our dreams, of our hopes, of like when you say rate cut, this is the quintessential thing that you get? Are we going to get that again?
There is this tendency to romanticize the idea of the Fed cutting rates. And I hear it all the time. Oh, if only the Fed would cut rates. Or, oh, wow, when they start to cut rates, like all of a sudden, everything's wonderful again. But the why of cutting rates is really, really important. In other words, we want the Fed to cut rates because the inflation pressures are receding and they can take the foot off the brake pedal. We don't want the Fed cutting rates because the economy's sputtering and it needs some stimulus. It needs some juice from the Fed. But yet, which is the one that's likely to produce a sharper, more pronounced decline in rates? It's the one where the economy rolls over. Hard to count that as a win. You mentioned mortgage rates, and I think, again, the context here is really important in the sense that if there is continued focus and concern in the bond market about escalating government debt, that's going to keep a floor under those long-term rates. So even if the Fed does start to cut short-term rates later in the year, What we see with mortgage rates is really going to depend on a different backdrop. Is the economy rolling over? In which case, those long-term rates will probably come down in a meaningful way, albeit in a weaker economic backdrop. Or, is it inflation pressures are receding, so the Fed's taken the foot off the brake pedal a little bit, but bond market is still very concerned about escalating government deficits and debt and what that means to the future, in which case you're not going to see a commensurate decline in those long-term rates.
Mortgage rates are still pretty high. They're like in the sixes, even towards 7. Home equity lines of credit, double digits. How anxious are the lenders to move off of that? Because again, you think rate cuts, you hope that you're going to get it, but we're not seeing a whole lot of movement.
I'm not seeing a whole lot of movement, but the Fed's been on the sidelines for 6 months, so there's not really the catalyst for that movement. And those inflation concerns and the concerns about debt and deficits, that's keeping a floor under those long-term rates. Mortgage rates are still at 7%. 10-year treasuries are at 4.5%. And so that's really what's producing that type of environment. Home equity lines of credit, it is no longer a low-cost source of borrowing. I think, for the better part of 20 years, homeowners sort of got trained on this idea that it's like borrowing for free because rates are so low and you can deduct the interest on your taxes. Well, a couple of things have changed. The tax law changed. It's not as easy to deduct the interest on your taxes. And then secondly, rates went way up. And so, you're no longer borrowing at some low or mid-single digit interest rate. In a lot of cases, it's 8, 9, 10%, or even higher. That is high cost debt, no matter how you slice it. Lenders are loving it. With mortgage rates at 7%, there's not a whole lot of cash out mortgage refinancing going on. So how do homeowners access that mountain of equity they're sitting on? They take out a home equity line. So, the lending business loves that side of it. But you talk to mortgage people and, they're rooting for lower mortgage rates.
I was going to say,
to really start bringing business in.
The lending side loves it. The mortgage side, they're watching the numbers suggest that home sales are slow and slowing and, what have you. There's never just the business impact to say, let me cut my margin just a little bit, drop that rate and hope I'm doing more business.
It's not really the margin that's propping it up. Most mortgages are, they get packaged into mortgage-backed securities and sold to investors. So, it's really investors that dictate what's available and at what rate in the mortgage market, where lenders have a little bit more flexibility as the stuff that they hold in their own portfolio. So maybe more of the, the higher end, high net worth jumbo loans, they've got a little bit more latitude. But, your standard 30-year fix, the one that's, on average around 7% right now, it's the mortgage-backed securities market that really dictates where those rates are. It's not fat lender margins that are propping that up.
Getting us back to the Fed stuff, if there is a surprise out of the Fed on Wednesday, what would it be to you? I get it. It's a surprise, so you're not really planning for it. But the thing that you're not expecting that at least is somehow in the lexicon.
I think if we got a meaningfully more dovish tone from the Fed, in other words, if all of a sudden you're not seeing such a hard line on the bar being high to cut interest rates, if all of a sudden that, they're a little more concerned about risks to the labor market and the idea of cutting interest rates, there isn't such a high bar for that. If you look at the Fed's dot plot and, there's, more of an aggressive tilt towards lower rates later in the year and into next year, I think that would come as a surprise, especially relative to what we've seen and heard over the last 3 months.
Greg, always great to catch up. Love getting the perspective. Thanks so much for joining me again on the show. I'm sure we'll talk to you again soon.
Thanks so much, Chuck. I appreciate it. Look forward to it.
That's Greg McBride, the chief financial analyst at Bankrate.com. So it's Bankrate.com if you're looking for more information. And yeah, if you're looking to shop around for more things in terms of financial products. Up next on Money Life, the big interview with Julia Hermann, global market strategist at New York Life Investments. Stick around.
Asset managers, you know how hard it is to stand out in this crowded space. VettaFi is a unique partner that can help you across the entire product lifecycle. With a best-in-class index factory and an award-winning digital marketing team, VettaFi can help you build the products of your dreams, optimize your distribution efforts, and grow your assets under management. Learn more at VettaFi.com.
Welcome to the big interview on the June 18th edition of Money Life. Returning to the show today, Julia Hermann. She is global market strategist at New York Life Investments. If you want to learn more, newyorklifeinvestments.com. But I will encourage you, instead of just going to that link, to find the longer link that we've got in our show notes or where you find Julia on the moneylifeshow.com guest page, because New York Life just released their 2025 Megatrends report looking at the next era of global debt sustainability. It digs into what we're seeing in debt in terms of the impact of the global debt situation, the investment opportunities, and a lot more. And we're going to get into that and more. But again, if you want to go check out the report, there is a direct link there for you in our show notes or on our guest page. Julia Hermann, it's great to have you back on Money Life.
Thank you so much for having me, Chuck.
Let's start with the report, because here we are at a spot in the middle of the year that this is kind of an outlook, and this is not the first time you guys have done this. This is like the third in a series of Megatrends reports. But debt has been, everybody's been focused on the equity markets and what's been going on with tariffs, et cetera. But debt is a huge part of the story right now. So let's start there in terms of the base case on Megatrends for debt.
Yeah, absolutely. So, this research every year is our chance to pull up above the cycle, above the week to week, and look at the next 10 years of investing. And this year, we decided it was time for a fresh conversation on sovereign debt sustainability, not just in the US, but globally. And we can focus our conversation on the US today because we have this huge spending bill making its way through Congress right now. We have senators saying that they're not willing to make our annual fiscal deficit any bigger. But if we're going to do that, it's going to require some really, really difficult choices. So, those choices, the way that a major economy manages its debt moving forward, that is the heart of this research. And I really believe that this is the most talked about, but most ignored topic in asset allocation, because even the most long term investors have not yet systemically been willing to incorporate this into how they allocate. And we see an opportunity for that to change going forward.
Well, let's talk about the debt picture, because, of course, it is one of these things that is not well understood. In fact, I think the media contributes to how poorly understood it is, et cetera. I mean, I certainly am somebody who has always said, I want less debt. I want less debt in my life. I want less debt in the companies I'm buying when I'm buying stocks. I want less debt in government. And at the same time, I don't fall for the rhetoric about, well, we're leaving all of this debt to the future, because we're also leaving the other side of it, which is their assets. Like, we're issuing debt and there's an asset on the other side of it. So it's not like we're completely destitute and insolvent. The picture that everybody wanted to talk about for a while was, what was happening with the US credit rating. And then that became a nothing burger. So because you're looking at megatrends, because they are 10 years, the things that folks were talking about involving US debt, is that a 10-year thing? Like, are we going to see those trouble spots come to roost? If something is not handled now, it'll happen in the next 10 years?
I think there's one or two Achilles heels, is what I'd call them, regarding US debt sustainability in particular, that could come to fruition in the next 10 years. But more broadly, I think about debt sustainability and specifically, really, debt management on an annual basis as a 100-year trend. The pain points that we see in US debt sustainability right now are twofold. The first is policy credibility. Any country needs to preserve and protect investor demand for their debt, because a country is not a household. A country is not a company. It has an almost unlimited set of tools with which it can extend and pretend, if you will, when it comes to its debt obligations. But a lot of that ability to attract investors to a country's debt comes through the form of policy credibility. Now, obviously, the current administration has been doing a lot to shake up the status quo of a lot of things, from trade to how we handle treasuries. But policy credibility has been a bipartisan issue for decades in terms of how we've accumulated this debt and how we service it. So we have a policy credibility question in the US. We also do have a near-term pain point on debt burden, which is the interest rate that the US is paying and the amount of debt that that interest rate is being paid on. Interestingly, interest rates are not high in the US when you look versus history. They're not even quite at their midpoint of their 25-year history. But we have a much larger debt pile to contend with. I do think that there's a lot of factors that contribute to sustainability of US debt, so the positive side of the coin, which we can certainly discuss. And that makes me more hopeful that adjusting to a more sustainable fiscal path in the near term, which in my view on debt sustainability is about 10 years, it doesn't necessarily need to be this traumatic market event. It could be as simple as signaling smaller fiscal deficits on an annual basis over time. But currently, that's going to require an element of discipline that we haven't seen from either side of the aisle.
When you look at the current situation, obviously the thing that we export more of than anything else is our debt. We do a heck of a job exporting our debt. No trade deficit when it comes to debt. Are we changing the market environment enough that at some point we find less willing buyers? We find folks that are, or does that not impact it because that's an emotion, and most certainly sovereign governments and most investors are completely unemotional when it comes to their money. If this is the best market and that's still the best debt or close to the best debt in the quantities I need, they're buying.
I am not as concerned about the decline of demand for US debt and the US dollar that I feel like a lot of the news flow has led many investors to be. Exactly to your point. And I'm so glad that you mentioned the fact that the US exports its debt because that is one side of a symbiotic relationship. We also have major countries out there, Germany, Japan, China, that equally rely on US Treasury debt to give them an absolutely guaranteed instrument that usually offers a moderate rate of return, and it's a place to park their savings. So this has been a symbiotic status quo that has lasted since the Second World War. Moving forward, there's been tons more questions lately about diversification of asset management outside the US, questions about demand for US Treasuries. But my answer to those questions is one more question. What's the alternative? What's the alternative to the dollar that's workable now? What's the alternative to treasury debt that investors can buy now? There are two potential alternatives that could theoretically come up here. One is Europe, but that is a not a single capital market. It's a very fragmented country level capital market on everything from sovereign debt to corporate credit. Then there is China, which theoretically does have the integrated scale, but it also has a closed capital account. And so it currently cannot cope with large amounts of foreign inflows or outflows. So the two most obvious alternatives to the dollar and to treasury markets are not currently workable. It would take a fair bit of legal, financial, political cost for either Europe or China. And I believe that that lack of alternative is a structural source of support for US debt, including in the next 10, 20, maybe even 50 years.
Let's also factor in, do trade wars wind up impacting debt? In other words, if we get to a spot where we are facing what we consider to be a significant global trade war or trade wars with specific individual countries, how much will that shake up the picture? Because trade and debt do go hand in hand, but they don't have to go hand.
It's again such a good question and such a good point, Chuck. The fact that about 60% of global trade and therefore global transactions are priced in dollars helps to reinforce US debt sustainability. Why? Because if you are trading most things, particularly commodities or many other items that are priced in dollars, fun fact that I didn't know before this research, aircraft are priced in dollars. Even if they're made outside of the US and sold to a purchaser outside the US, aircraft are treated as a commodity that's priced in dollars. So, just one example. So, if you have to hold dollars anyway in order to trade and in order to make your global transactions, it's much better to hold a treasury bond that gives you some yield as opposed to a physical fiat dollar that yields you nothing. And so, you're completely right that the flow of trade globally has been one of the factors reinforcing that symbiosis where the US gets its trade deficit financed along with its fiscal deficit, and the rest of the world has a usually moderate guaranteed risk, moderate rate of return on treasury debt in return.
Given the short term events, and I get it, it's a long term thing, but was there any market action on the debt side of things globally that surprised you as we went through the first steps? Because we're not through it. Obviously, July 9th is the next shoe to drop, and we'll see what's going to happen. But given the policy shifts, et cetera, is there something that you are looking for or that's now on your radar screen that wasn't prior to all of this?
Absolutely. We are seeing a renewed interest in global diversification, both by US allocators and by global allocators thinking about their relative positioning in the US. Anecdotally, I have heard that some investors are looking to shorten the duration of their US exposure, keep it a little bit more short term, and sort of hedge out those longer term risks. I have heard investors wanting to find instruments in the US that are a little bit more liquid, again, a way to hedge against longer term policy questions in the US. And we're seeing flows there. Importantly, even small shifts in the narrative of US dominance can mean very large flows in support of areas like Europe or Japan. So this is happening, this is meaningful. There's also one other area of the market where we see diversification away from the dollar, which also essentially means treasuries, as a safe haven, and that is gold. We are seeing global central banks building up their gold reserves, and this was a piece of the puzzle that really came into the picture when Russia invaded Ukraine. It was sanctioned, it was cut off from the global SWIFT payment system. Its dollar holdings essentially became worthless overnight, and they compensated for that by purchasing gold, among other currencies. So that trend has become more global. It's been done by friend and foe from the United States perspective. And it just, again, shows a point of diversification about where do investors want to go when they need a little bit of safety. But again, this is all at the margin. 60% of global reserves are still priced in dollars. And we may be looking at a downward glide path in terms of US dominance of the system. But arguably, that's just a reflection of a more diversified global economy. So it doesn't necessarily ring huge alarm bells for me when it comes to structural demand for treasuries and US debt service moving forward.
We have also seen a huge demand for private credit and changes in the market that way. From an investment standpoint, well, that is less transparent, less liquid, et cetera, but also higher yielding and an attractive space because of that higher yield. So I'm curious because it wasn't really the focus of the report, but I know you look at it. Where are you right now on the private credit side of things? And the constant worry that I have is that as that asset class has gotten more popular, you've got more people buying stuff that they're not aware of. You've got companies bringing more to market. And at some point, historically, assets get popular. If they're a liquid, we then have a blow up. There's a problem that changes how popular they are and what happens. Does that have to happen with private credit? Like, as you watch that get this popular, are you looking at this going, okay, great, but there's trouble coming?
Well, I don't think that anything like that necessarily has to happen in any asset class. And I would offer private equity as an example there, where that asset class became incredibly popular. And the original business model of that asset class had to adapt a little bit. And its illiquidity premium looks a little bit different now. Its structural returns are a little bit different now. And specifically, you've seen a lot of activity move toward smaller companies in both private equity and private credit. You have a lot of companies now that are choosing not to go public, and the number of public companies has shrank over the past several years, while the number of private companies has grown significantly. So, in some ways, this is a simple reflection of market structure. And in many ways, it actually might be healthy in that these companies are not held to quarterly reporting. They can make long term decisions that perhaps in a public market context, they may not have investor tolerance for. Now, in private credit specifically, we hear so much interest about the space for obvious reasons, and also the skittishness that you raised, which is this is a less transparent space. Is there risk that we don't know about? We're moving from this very syndicated credit backdrop where risk is really shared across lenders to now a more concentrated version of that lending model. What does that mean? What we've been finding is not hidden credit quality issues. And of course, we as a platform at New York Life Investments don't have perfect vision into every single corner of the market, but we do have a particular look into the lower middle market space. Of course, we've seen some challenges on credit creation across public and private markets now that interest rates have not been coming down as much as expected. But generally speaking, we're seeing quite a bit of dynamism, and again, a reflection of market structure in favor of companies going private and staying private.
Now I get to move into the part that I've been waiting for since I knew we had this interview set up, beyond talking about megatrends, because I've been dying to ask you a question since saw what happened on Liberation Day. You were last on the show in the middle of February, on Valentine's Day, actually, was when that show aired. And at the time, you said that you felt the economy was strong enough to avoid a recession and overcome anything but an exogenous shock. So something at the pretty severe end of the spectrum. And of course, we have to this point avoided recession. We didn't really avoid exogenous shock. We just had it. And then we kind of said, okay, let's push the rest of this down the road. So I'm curious, as we sit here today, how worried are you that whatever we're going to hear and settle on with tariffs might become the rest of that exogenous shock? Or are you more confident now that this economy is strong enough that whatever gets dealt out, we're not having a recession?
Well, we certainly did have something that looks a lot like an exogenous shock on April 2nd, exactly to your point. And really what happened that day is that the tariff announcements approximated the market's worst case scenario, and market pricing immediately began to reflect that. But as you noted, since then, we have seen a few very important things that happened all in a row. The first is that we've seen tariffs outright negotiated away. I'm a little bit hesitant to hang my hat on that because these are not official trade agreements, right? These are not validated by Congress. These are sort of word of mouth agreements that are happening with China and other trade partners. But for now, we know that negotiations are working to bring down the effective tariff rate. We have also seen tariffs pushed back and paused. That is just a deferral of volatility, I think, more than anything. We've also had courts come in. And in some cases, those courts have ruled that some small businesses are entitled to damages related to tariffs. And we've also, of course, had large courts in the trade bodies ruling on what the authority is around tariffs. So we have all these question marks about the policy itself. What is the tariff rate going to be? Nobody knows. Absolutely nobody knows. But here's what we do know. The economy went into this year, like I said in February, on probably the strongest footing that we possibly could have hoped for. And between then and now, the economy has still been strong. Yes, we had a negative GDP print in the first quarter, but that really had little to do with fundamental consumption and everything to do with a mathematical import figure, which came from everyone trying to pull forward their spending ahead of tariffs. So we know that the economy is very strong. Relatively speaking, for our outlook for the second half of the year, we're pretty constructive. We see upside pressures on inflation, downside pressures on growth, but we're no longer really convinced, or rather, I should say, on April 2nd, we saw a relatively small possibility of a recession. And I would say that that possibility is actually getting smaller and smaller because those extremes have started to come off the table. The extreme scenario in which we are tariffing Chinese goods at 145%, that's an embargo. That's something that companies can't afford. It's something that households can't afford. That to me is the recession scenario, and we've seen a more moderate approach in the last few months.
Given that, take it from your economic outlook to what the market's doing. I mean, there are plenty of people who entered this year thinking, if we get to the middle of the year and we're modestly up and we've had a lot of volatility, that's about where I expect it to be. They've got that forecast as long as you ignore the day to day and how off it was at various points, because they certainly didn't foresee what was coming.
Mm-hmm.
But from here to the end of the year, what's your base case?
So we don't make outright forecasts specifically regarding equity market levels, for example, but let's talk about relative pricing. Everything that I just said about tariffs, they've become a little bit more moderate. The extremes have been negotiated off the table. That's great, but tariff risk is still there. It's also just one part of the policy uncertainty spectrum out there, which we've seen in the past few weeks. And per our discussion just now, it's broadened to now include questions about tax policy and government spending and debt sustainability. We have yet to see key portions of the Trump platform, including comprehensive immigration movements and comprehensive deregulation movements, hit the market. So we have a lot of risk, and almost none of that is priced in, not just in US equities, but in US corporate credit spreads, in European equities, in Japanese equities. The list goes on and on and on. So I am certainly concerned about volatility between now and the end of the year. Volatility does work in both directions, but I wouldn't be surprised if, as we start to see tariffs really begin to work their way into the economy and that impact is more felt, for asset valuations to reflect those risks accordingly.
And in terms of bringing this back full circle as we wrap up here, what you see happening in the rate market, et cetera, I mean, talked this entire time without getting around to the Fed, but I don't know that you can have a conversation that doesn't involve the Fed. So in whatever outcome you're seeing, both for equity markets, but also for global credit markets that we've been discussing, what do you expect from the Fed and how big will that impact be? Because when the Fed made cuts last year, everybody cheered the cuts, but they weren't the romantic, hey, you cut, look what happens kind of cuts. That didn't happen. So are we getting classic cuts or are we not getting classic cuts when they finally come, if they come?
I think the Fed is going to do as little as possible for as long as possible in that environment. And there are two reasons for this. And we're recording on June 17th. Fed Day is tomorrow. So this is the perfect day to be talking about this. But the Fed is constrained in two different ways when it comes to today's market. We have upside pressures on inflation, downside pressures on growth. That pulls the Fed's mandate in two different directions. Anything that comes anywhere close to stagflation or stagflation light or whatever you want to call it is very, very difficult for the Fed to deal with, because if you hike, you might be contributing to one problem in the economy, and if you cut, you might be contributing to another problem in the economy. So that's the fundamentals. Then you also have the fact that the Fed, essentially what they're doing is they're controlling the price of money, the price of credit, to affect how much we demand, right? So if loans are more expensive, we might not expand our small business. They can't do as much when ships were stuck off of LA Harbor in the pandemic. They couldn't do as much when the Ever Given was stuck in the Suez, right? And they can't necessarily do a ton if there is a supply side disjointedness that's inflationary. Their tools simply aren't that effective. So I would expect to see the Fed on hold through the end of the year, maybe sneaking one cut in if they can, simply to show their willingness to support the economy. But generally speaking, I think we're looking at the front end of the curve on hold for at least the next 6 months.
Julia, great stuff. I appreciate you taking the time to join me. We'll watch how it plays out. We'll talk to you again down the line to see how your outlook is changing and adapt.
Thank you so much for having me.
That's Julia Hermann. She's global market strategist for New York Life Investments. It's NewYorkLifeInvestments.com. The direct link that'll get you to their 2025 Megatrends report is in our show notes as well. And again, NewYorkLifeInvestments.com. We will wrap up the June 18th edition of Money Life in just a moment. So stick with us. The finish line is in sight. Don't give up before we cross it. We're back to wrap this one up. You know, it's not just because we've been super busy that we've been doing 3 interviews instead of our standard 4, although I think 3 is becoming a more standard show. It's just been that the commentary has been really good, and I've been letting the interviews run. We've had a number of interviews in the last week that have been like 24 minutes long, which is about as long as we could go with just about anybody, unless we're going to do 2-part interviews, which we typically do not do. But I mean, I'm not against it. I just think that those conversations have been full, ready to go, etc. And normally I want them a little bit tighter than that, but I think they've been pretty good. But let me know what you think. Chuck at moneylifeshow.com is how you reach me. I appreciate it. I like knowing how, like, I don't want to change the show markedly and have you guys hating the change. So let me know. Now, tomorrow, of course, is Juneteenth, and we are taking the day off. But we are here on Friday, and the show will be worth it. Like, if you're getting away for the weekend early, come on back, because Friday, Brian Levitt, global market strategist at Invesco, will be here for the big interview. Jeff Crumpelman from Mariner Wealth will be here talking technicals. John Cole Scott from Closed End Fund Advisors will be here talking closed end funds in the Navigator. So we've got all of that and more, and we are around and back to our regularly scheduled stuff next week, and take a day off for July 4th, but otherwise, and we are heading into July with great things on the schedule. I'm super excited for what's coming. I will tell you more about that as we move forward, but please enjoy the holiday, then come back to us, because Friday show, Brian Levitt, one of my favorite folks to chat with. He has ties. We're not of the same age, but we both went to the same university and the same high school. If you are looking for something to do today, because, well, tomorrow is a holiday, but you want to get started today, it is Autistic Pride Day. And my stepdaughters, Taylor and Mackenzie, both work with autistic kids. I'm more and more exposed all the time, but it has touched my family as well. The more you know about it, the better off everyone is, because autism is an incredibly large deal in this country. I think there are plenty of people who are on the autism spectrum someplace that have gone undiagnosed. The more we know about it, the better we're all going to be. So stand up, Autistic Pride Day today. It's National Want to Get Away Day, which actually was created by Southwest Airlines. But you could get away any place with anybody. It is National Splurge Day, if you want to go splurging. It is National Go Fishing Day.
You fish now.
You don't have to be that way. You could be more relaxed about it.
Still think there are bigger fish to fry out there.
If there are bigger fish to fry out there, that's good, because then you can go on a picnic, because it's International Picnic Day.
I'm smarter than the average bear.
Do worry about who might be unintended and at your picnic. And if your picnic goes bad, well, it's also International Panic Day.
We can make it, you guys. We can't panic.
Unless, of course, there's reason to panic. On the food front, International Sushi Day and National Cheesemakers Day.
Bless it all the cheesemakers.
By the way, I've got a cheesemaker. There's a place that I order some cheese from in Vermont. I wholeheartedly recommend it. I've actually got another place in California as well. If you want to know my cheesemongers, the folks that are making the cheese that I get shipped to me that may or may not be available in your stores, let me know. I'll happily share those tips with you. My guests today were Todd Rosenbluth, head of research at Vetify, vetify.com for more information. Greg McBride, chief financial analyst at bankrate.com, and Julia Hermann, global market strategist at New York Life Investments, newyorklifeinvestments.com. Thanks to them. Thanks to Rob Floyd, my producer. Thanks to Maho, my dog. But mostly, thanks to you for being here, because you make this special and worthwhile for me each and every day. The Money Life quote of the day comes from Isaac Asimov, the science fiction writer, who said, "If the love of money is the root of all evil, the need of money is most certainly the root of all despair." Well, we hope you are not despairing ever when it comes to your money, that you're keeping it in perspective and in the right place. And if you are, you'll remember that until we do this again the next time, the best thing you could do for your money is not worry too much about it. Have a great day, everybody, and a great Juneteenth holiday. Stay safe and calm. We'll see you here again tomorrow.
The people who appear on Money
Friday
Life are here for your and their own entertainment. Don't take advice from us or any other podcast without doing more research and/or consulting your financial advisor. We believe our guests provide reliable information, but we can't and don't guarantee the accuracy or completeness of their statements. Opinions expressed on Money Life are those of the host and guests only and reflect their personal thinking. They're not representative policy or strategy of any employers or sponsors. This show is produced by Money Life Radio, which retains all rights to the content. If you want to use any part of this show for your own purposes, be they good or evil, you must get our written permission first. And remember, with great financial information comes great responsibility. Please act responsibly.
Have a nice day.